All right, let's dive straight into this explainer and completely dismantle the age-old debate of whether you should pay off debt or invest your money. For decades, financial gurus have been screaming at you from two completely opposite camps, right? It's like your money is stuck in this giant tug-of-war. One side insists debt is a 5-alarm fire and you must pay it off instantly. The other side, they say, stretch that debt out, invest the difference, and capture the market's higher returns. But what if I told you they're both having the exact same totally wrong conversation? Today, we're going to unify your balance sheet and completely flip how you view risk.
So we're going to examine these two widely accepted yet completely opposite financial strategies. And to really grasp this, to figure out which path is actually safer, you need to meet our two case studies, Jake and Vanessa. They're going to help us answer the ultimate question of which path protects your money better. Because as it turns out, the way we normally measure financial risk is fundamentally broken.
On one side, we've got Jake. Jake is all about the spread. He just pays the bare minimums on his debt, and everything else automatically gets swept into his 401k, specifically into a default target date fund. He's sensible, he's relaxed, he's basically doing exactly what standard advice tells him to do. And then on the other side, we have Vanessa. She looks at debt as a leash. She is intensely attacking her loan balances with every single spare dollar she can scrape together. And because she's so fiercely focused on getting to zero debt, she's dumped her retirement entirely into stocks, figuring, hey, I've got decades to ride out the market. Now, despite these radically different mindsets, it is absolutely crucial for this framework that we put them at the exact same starting line. They are both 38 years old. They both pull in $92,000 a year, putting them in a 22% tax bracket. They both owe exactly $48,000 in total debt, split across a high-interest credit card, a car loan, and a low-interest student loan. They each have a 401k sitting at exactly $120,000, and at the end of the month, after all expenses and minimum payments, they both have exactly $600 left over to deploy. Same numbers, exact same starting line. The only difference between them is their belief system. Okay. Let's zoom in on Jake first. Jake thinks he's the balanced, conservative one here. He intentionally picked a 2050 target date fund because he didn't want to take on crazy risk. If you check his fund's fact sheet, it holds about 89% in stocks and a modest 11% in bonds. He probably hasn't even thought much about those bonds, but he knows they're in there to act as a shock absorber for when the stock market gets bumpy. That's his perceived safety net.
But if you were to open your own 401k statement right now and actually look past that very first line, you'd uncover a massive flaw in how we all measure financial risk. See, Jake's statement says he's 89% stocks and 11% bonds. And inside that specific account, sure, that's completely true. But Jake doesn't just own the account. Jake owns his entire net worth. And because nobody ever told him to look at his investments and his debts on the exact same page, he is walking blindfolded right into a trap. Here is the crucial breakthrough you need to understand. A bond and a loan are the exact same financial instrument. Literally the same thing. They carry the exact same risk. Think about it. A bond is just a promise where you hand someone money and they pay you a fixed rate on a schedule. A loan? That's the identical promise, just pointed in the other direction. The only difference between the bond sitting in Jake's 401k and that car loan parked in his driveway is the plus or minus sign in front of the number.
Because of this unified balance sheet reality, we have to calculate Jake's true net worth. Let's run the math together real quick. He has $120,000 in assets, minus $48,000 in debt, meaning his actual true net worth is only $72,000. But his stock position alone is over $107,000. So when you take that massive stock position and divide it by his actual net worth, you realize Jake's true asset allocation is absolutely not 89%. He is running 1.5 times leverage in the market. At 149% leveraged, Jake isn't a conservative investor at all.
And this brilliantly illustrates the hidden danger of leverage. Let's run a quick crash test. Imagine a 2008-style meltdown where the market drops 37%. Jake looks at his perceived 89% stock allocation and expects to lose about a third of his money. Now, a 33% drop is brutal for sure, but it's survivable. But watch what actually happens. His stocks plummet, his bonds hold steady, but his debt never moves. That is the whole point of debt. Because his debt stays firmly at $48,000, his total net worth collapses from $72,000 all the way down to roughly $32,000. He didn't lose a third. He actually lost over 55% of his net worth.
He expected to lose 33%, but lost 55%. That gap isn't just bad luck. By dividing his total assets by his net worth, we uncover this terrifying multiplier for leverage. For Jake, that ratio is 1.67. What this means is that every single market downturn for the rest of his life is going to hurt Jake 67% more than he thinks it will. And you know what? His 401k statement will never warn him about this, because his 401k has no idea he has a car loan.
So let's flip over to Vanessa and see how this builds for her. Vanessa actually yanked her entire retirement account out of target date funds and dumped it straight into an S&P 500 index fund. 100% stocks, 0% bonds. She confidently believes she is the absolute most aggressive investor out there, just totally living on the edge with zero financial training wheels.
And her instinct is totally right at the very beginning. Because of her debt, her stock allocation starts out highly leveraged at an incredible 167% of her net worth. But here's the thing she doesn't realize about the mathematical reality of her strategy. Every month, she furiously sends an extra $600 to her lender. Guys, a debt payoff isn't just like a bond purchase, it is literally buying a guaranteed fixed-rate bond with zero market risk.
Because paying down debt is buying bonds, watch what this does to Vanessa's risk profile. Over just 37 months of crushing those loans, Vanessa eventually hits a zero debt balance. But on that exact day, her stock exposure equals exactly 100% of her net worth. She started at 167% leverage and finished at 100. She accidentally shifted her risk exposure by 67 percentage points. A standard target date fund takes like 25 years to execute a risk shift that huge. She executed a massive portfolio de-risking in just 3 years, and she never consciously planned or controlled it.
And here is where the tragedy of their disconnected balance sheets really peaks. Jake is passively holding bonds in his 401k, earning maybe 4.7%, all while borrowing on a car loan at 7%. He's literally lending out money for cheaper than he's borrowing it, and that's costing him about $287 a year. Ironically, Vanessa is just as blind. By furiously paying off her 3.5% student loan, instead of capturing the open market's 4.7% baseline yield, she is voluntarily buying the absolute worst yielding bonds available. Her fierce discipline bleeds her of $297 a year. They have completely opposite instincts, yet they're bleeding almost the exact same amount of money annually. The irony is just staggering.
Now, before we carve this into stone as the ultimate financial law, we do have to acknowledge a few real-world exceptions to this framework. First, weird market anomalies like 2022, where stocks and bonds both tanked together, proving bonds aren't a perfect magic hedge. We also have to remember account tax differences. 401k bonds are tax-deferred, while paying off debt is effectively a tax-free return. Then there's the vital cost of losing liquidity. When you pay off a loan, you can't just ask the bank for that cash back in an emergency, so you have to demand a liquidity premium for locking it up. Oh, and of course, if you have a 401k employer match, go get that first. Absolutely nothing beats a guaranteed 50% return on day one.
So keeping those exceptions in mind, how do we actually solve this debt dilemma once and for all? Well, we need to calculate your personal stop line, which is basically your hurdle rate. Step 1, find your baseline bond yield. What is the open market guaranteeing you today? Let's call it 4.74%. Step 2, adjust for your tax bracket if you're holding bonds in a taxable account. And step 3, add that premium for liquidity. Let's just say 1%, since cash locked up in a paid-off loan can't be spent. For Jake, when we run this math, his personal stop line lands cleanly at 5.74%. Now, what's really fascinating here is when we apply Jake's calculated 5.74% stop line to his specific debts, the math acts like a ruthless financial guillotine. His 22% credit card and his 7% car loan sit clearly above the stop line. The math dictates those must be killed immediately. Paying off that credit card is the equivalent of buying a guaranteed, tax-free bond yielding 22%. There is absolutely no way he will ever be offered a fixed income instrument that good again. But look at what happens below the line. His 3.5% student loan sits safely below his 5.74% stop line. This means paying it off early is the equivalent of buying a terrible 3.5% bond, especially when the open market will happily hand him 4.74% guaranteed. So the mathematically correct answer? Pay the bare minimum, never send a single extra dollar, and simply hold on to that cheap leverage forever. You know, popular internet strategies like the debt snowball or the debt avalanche will have people arguing endlessly about the exact order to pay off loans. But if you run the numbers over a 20-year period, optimizing the payoff order is only worth maybe a couple $1,000s. However, using this mathematical stop line, knowing exactly when to stop paying extra on your debt and start investing instead, is worth over $19,000 more to our investors. It proves the payoff order barely matters compared to knowing exactly where the line is.
So it's time to stop having the wrong debate. Unify your balance sheet, calculate your stop line, and look at your debts for what they mathematically are. Stop asking whether you should invest or pay off debt, unify it all, and ask yourself the only version of the question that actually has a mathematically correct answer. Which of these bonds do I actually want to own?